From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. During the presidential campaign, Donald Trump focused on several critical items, including border security, trade and tariffs, and taxes. Recently, the focus has been on the impact of the Trump's tariffs on the U.S. economy and investors. To help us navigate the discussion, we welcome Jerry Herman, chartered financial analyst and a member of our investment committee. So, Jerry, where do we get started?
So, President Trump has proposed 25% tariffs on Canada and Mexico and an additional 10% on China. The basic idea is to protect U.S. industry, to lower the trade deficit, and also influence the policies of foreign governments. Really, the case for tariffs is that international players import cheap goods into the U.S. due to their low labor costs and subsidies from their government. So the real idea here is to encourage domestic production by making imported goods more expensive.
Yeah, and this really departs from what we saw in the last Trump administration, doesn't it?
These tariffs are broad and aggressive. In 2018, Trump imposed tariffs on steel and aluminum products. But in this case, they are much broader and span across multiple trading partners. The estimates that are out there suggest that it will raise or generate over $100 billion.
And while tariffs can generate substantial revenue, some experts argue that these tariffs could hurt more than help. So what kind of economic impact should we prepare for?
Think about tariffs as a tax on imports, meaning that companies that rely on imports, they would experience increasing costs. That could raise their prices, causing inflation, which is exactly what we've been dealing with for the last several years. So companies with multinational supply chains might initially have to deal with some changes.
And much depends on how trading partners really respond. So if Canada, Mexico, and China retaliate, U.S. exports could suffer. But tariffs could also discourage foreign investment, slow economic growth, lead to job losses, and even increase market volatility.
So investors should brace for volatility as things could change quickly. Automotive manufacturers, for example, that rely on supply chains from Mexico and Canada could actually experience increasing costs, thus squeezing their profits. Some industries could actually benefit. Domestic aluminum and steel producers could actually gain advantage, increase demand, because foreign competing products will actually cost more. Agricultural products could be sort of a mixed bag. Producers, farmers that export could actually be hurt by retaliatory tariffs, whereas those that focus on the domestic market could actually gain advantage. So in the event that prices do rise and rates go up, it could impact the equity and bond markets, maybe consumer consumption patterns. But really the key in this uncertain environment is to remain diversified.
Well, Jerry, we're really thankful for all the work that you and the rest of the investment committee do for our clients and their portfolios. If you're concerned about the economy, market volatility, or simply want an experienced team to review your portfolio, give us a call. Here's Fox News Sunday.